Hi guys, in this video we are going to cover a very important topic for SEBI, that is Securities and Exchange Board of India. So this topic is SEBI Annual Report 2017-18. Now this is a very bulky report and we have tried to pick out the important points in this particular report which are relevant for our upcoming examination. But still it was a bit bulky and we have to divide this particular report into three separate parts, and we are going to have three separate videos for this annual report. So now let's start our discussion with the first part of SEBI Annual Report 2017-18. So let's start by taking a look at the background of this particular report. So this report is issued under separate rules, and these are Securities and Exchange Board of India Annual Report Rules 1994. So they deal with the preparation of this annual report. Now this report talks about how SEBI has continued its efforts towards achieving its statutory objectives. Now there are three more important statutory objectives of SEBI, and they include protection of interests of investors in securities. So the investors who are dealing in securities market, their interest has to be protected. The securities market has to be developed. The money market, the capital market, the stock markets, the intermediaries, the investors, all they have to be developed. Regulation of the securities market. Now for proper development, the regulation is very essential. So there has to be proper rules and regulations in place so that the interests of the investors, they are protected and the development of securities market can be done. Now these are the statutes which govern the objectives of SEBI, and these are the objectives which SEBI is trying to accomplish, and SEBI has showcased how these have been achieved through this annual report. So if we talk about these statutes, they include Securities and Exchange Board of India Act 1992, Securities Contract Regulation Act 1956, Depositories Act 1996, and certain provisions of the Companies Act 2013, because the companies are the ones who are listed on the securities space and they have to be regulated. Now this annual report has been divided into four parts, and the first part, it talks about the policies and programs of SEBI formulated during the year. The second part is about the trends and operations in the securities market. So it has some of the very important facts with regard to the securities market. And the third part, it relates to the functions of SEBI and the regulatory actions which have been taken by SEBI. And the fourth part, it is more of a basic part. It talks about the conceptual framework, and it's about the organizational framework of SEBI. So let's start our discussion with the first part, which is policies and programs. Now this part, it starts with a review of general macroeconomic environment and the investment climate in the country as well as the world. Next, it moves to review of policies and programs of SEBI, and then it talks about assessment of these policies and what are the future prospects which are going to happen with regard to securities market space. So when we talk about the review of the general economic environment and investment climate, the report says that the global economic activity began to recover since mid-2016, and since then it has gained certain momentum, and this is seen in both advanced as well as emerging market economies including India. IMF in its April 2018 World Economic Outlook, so this is a very important report which is published by IMF. It has projected that the world economy is going to grow at 3.9% in 2018 as well as 19. And if we talk about India, it has been among the fastest growing economies in the world in recent years. And if we look forward, Indian economic activity is expected to consolidate further. It is expected to improve further in 2018-19. So the prospect remains positive. Now let's take a look at the different policies and programs initiated during 2017-18 by SEBI. Now first, let's talk about the primary securities market. So this is the market in which the securities, they are issued for the first time by the company to the investors. Now primary securities market, it is very crucial for resource mobilization and capital formation in the country. So SEBI is very much concerned about its development, and it has initiated different steps with regard to primary securities market. So first one is standard operating procedure on a non-compliance of minimum public shareholding requirements by listed entities. Now before jumping on to what I have written in the slide, let's just discuss what is the heading about. So it's talking about a procedure which is to be adopted if there is non-compliance with regard to minimum public shareholding. So as per SEBI norms, there has to be certain level of minimum public shareholding in the public companies. So if the norms, they are not complied with, if this minimum public shareholding requirement is not met, what is going to happen? So this is this standard operating procedure which is going to take place. So this has been specified by SEBI, and this has to be followed by the recognized stock exchanges and depositories in case of non-compliance with the minimum public shareholding requirements by listed entities. So in short, they are called MPS requirements. Now it talks about different actions which are to be taken, like imposition of fines, freezing the shares of promoters, debarring promoters and directors to take new directorship in other companies. Further, it also talks about enhanced fines and freezing of entire securities in the demat account of the promoter. So not only the securities in such company which has not complied with these norms, but all the securities of the promoters, they can be freezed in case of non-compliance if it continues for more than 1 year. So if this non-compliance it continues for more than 1 year, stringent action is going to be taken against the promoters. Next is disclosure of divergence in the asset classification and provisioning by banks. Now SEBI has mandated listed banks. So this is more or less relevant for the listed banks to disclose to the stock exchange any divergence in the asset classification and provisioning. Now wherever the additional provisioning requirement which has been assessed by RBI, it is more than 15% of the published net profits, and the additional gross non-performing assets identified by RBI exceed 15% of the published gross NPAs for the period, then the reporting has to be done. Then this is to be disclosed to the stock exchange. So if your provisioning is not adequate, or your additional NPAs are there which have been identified by RBI but it has not been in the public domain, so these have to be disclosed in the report to the stock exchanges by the listed banks. So this disclosure requirement is in conformity with the RBI norms. Next is again about a standard operating procedure, and this one relates to non-compliance with SEBI ICDR, that is SEBI Issue of Capital and Disclosure Requirements Regulations 2009. So again it talks about levy of fine in case of non-compliance with these regulations, and it talks about a delay in completion of bonus issue, and if the company is not allotting the shares on conversion of convertible securities. Say the company had issued convertible debentures and now they have to be converted, but the company is not converting them and allotting the shares to the holders of the debentures. And if the company has not approached the stock exchange for listing of shares within 20 days from the date of allotment. So these are some of the compliances which have to be made by the company with regard to issue of capital, and if they have not been done, then also fines can be imposed and actions can be taken. Next is about monitoring of utilization of issue proceeds. So in a primary market, a company comes up with the issue and the investors, they are investing in that particular issue. Now an important aspect is that whatever money has been realized by the company through this issue, it should be monitored that how the company is utilizing this money. So this one is with regard to this fact only. So SEBI ICDR Regulations 2009, they require mandatory appointment of monitoring agency if the issue size of the securities it exceeds rupees 500 crores. So this is important. It may be asked when a monitoring agency has to be appointed. So we have to remember if the issue size exceeds rupees 500 crores. Now SEBI board has approved certain proposal to further strengthen the monitoring of issue proceeds in case of IPOs, that is initial public offers, FPOs, that is follow-on public offers, and rights issues by the company. Now the key proposals, they include appointment of monitoring agency where the issue size, excluding offer for sale component. So there can be an offer for sale component in which the shares, they are being sold by the promoters to the market. So if we exclude this offer for sale component, then it is provided that if it is more than 100 crores, then the monitoring agency should be appointed. In certain cases, also maximum timeline has been introduced of 45 days for submission of report by this monitoring agency from the end of quarter. So quarterly report has to be furnished by this monitoring agency, and this report must be published within 45 days of the end of quarter. Now next is inclusion of RBI registered systematically important NBFCs in the category of QIBs. So first and foremost, we have to know that there are separate categories of NBFCs which are there, and one of the categories is systematically important NBFCs. Now these NBFCs which are registered with the RBI and they are having a net worth of more than 500 crores, they have been included in this category which is of qualified institutional buyers. Now if you are aware about the allotment of securities, then there are separate categories of investors. There can be retail investors, there can be qualified institutional buyers. So when we talk about the issue space, then one of the quotas have been reserved for these qualified institutional buyers. So now this has been expanded, this definition has been expanded by including systematically important NBFCs. As NBFCs, they are well regulated entities, so if you classify them as QIBs, it is going to give the issuing company a larger pool of funds. So it can get a larger pool of funds in the QIB quota through the issue of securities. And accordingly, the SEBI ICDR regulations, they have been suitably amended in this regard in May 2017. Next is compensation to retail individual investors in an IPO. Now, we all are aware that SEBI has made the application supported by blocked amount. This is ASBA. So this is mandatory from 1st of January 2016. Now this process of ASBA, it has resulted in complete elimination of complaints relating to refunds. So you'll be clear about this if you understand this mechanism of ASBA, which I've already talked about many a times. So as of now, I'm not discussing that. So there have been instances where the applicants in an IPO, they have failed to get the allotment. And in this process, they have suffered this opportunity loss. So SEBI has now laid down a comprehensive framework in this regard, which provides that they should be provided some minimum compensation to the investors in such kind of situations, where they are not being allotted the securities and they are suffering some kind of loss due to blockage of money in this facility. Now next is Primary Market Advisory Committee. So this committee has been constituted to advise on the issues relating to primary market, and this was recently reconstituted, and it comprises of 21 members from various market participants and 3 members from SEBI. So it has a very wide domain of members, and this one is chaired by Shri TV Mohandas Pai, who is the chairman of Manipal Global Education Services Private Limited. And if we talk about the progress during the year, this committee met once during the current financial year, and it discussed the policy issues relating to ICDR regulations, and it also made a few key recommendations in this regard. More importantly, we have to remember that there is a separate committee in this regard, and it is chaired by Shri TV Mohandas Pai. Now let's move on to secondary securities market, and this is the market in which the investors, they trade the securities among themselves through the stock exchange. Now first one with regard to this is the online registration mechanism and filing system for stock exchanges. Now we are all aware that stock exchanges, they are well regulated by SEBI and they have to fulfill certain compliance norms, and in this regard they have to file certain returns, file certain forms to SEBI. And now this has been done online. So SEBI has introduced a digital platform for online filings related to stock exchange. So this has been done to ease the process of application for recognition, renewal, reporting and other filings which have to be made by stock exchange in any rules, regulations, circulars, etc. So they can be SCRA rules or regulations 2012 and other circulars. So more importantly, we have to remember that now the stock exchanges, they can comply with different norms. They can even apply for registration through online mechanism of SEBI. Next is online registration mechanism and filing system for clearing corporations. So as for the stock exchange, a new mechanism has also been introduced for clearing corporations. So in order to ease the process of applying for recognition, applying for renewal and making other filings with SEBI, SEBI has introduced a new platform, which is a digital platform for all the online filings related to depositories. So if they have to comply with any kinds of norms, any kinds of regulations, any kind of form they have to submit, they can do so through this digital platform. So all the applicants who are desirous of seeking registration or renewal of registration as depositories, they can submit their application through this online portal, which is siportal.sebi.gov.in, and all the filings that they have to do, the monthly reports, annual financial statements, returns, etc., they are also to be submitted online. Now the next one is about recording of non-disposal undertaking, that is NDU, in the depository system. So SEBI has directed the depositories that they develop a separate module for recording of non-disposal undertakings. Now what are these NDUs or non-disposal undertakings? So they are typically undertakings which are given by a shareholder to the depository that they are not to be transfer the securities of that shareholder or otherwise alienate that securities. So they are in the nature of negative lien given in favor of another party, usually a lender. So let's understand this. So for example, there may be a case where I am owning certain shares in Reliance Limited. So what may happen that I have to repay some money of some another person, and what I tell that person that till I repay your money, I have kept these shares as a pledge. So now these shares should not be transferred by the depository because they have been kept as a pledge. So that's why I have to give this non-disposal undertaking to the depository. So this is the purpose and role of this NDU. And further, as per the SEBI Substantial Acquisition of Shares and Takeover Regulations, they require the promoters of a company that they disclose the details of their encumbered shares on which certain charge is there, and one of the category can be these NDUs by promoters. So they are in the nature of encumbrances and they have to be disclosed under these regulations. Next is comprehensive review of margin trading facility. So we have discussed many times about margin trading facility, that how you can get yourself exposed to multiple times of profits through margin trading. Now SEBI in 2004 had prescribed this framework which permitted the stock brokers that they can provide this margin trading facility to their clients. So you do not need the entire money to buy the shares, you just need the margin to get the exposure. The framework for this margin trading facility has been revised with effect from June 2017, and the focus is to encourage trading in cash segment because this carries a lot of risk. The marginal trading facility is a lot risky, and that's why the focus is to encourage trading in cash segment rather than moving towards this margin trading segment. Next is a review of offer for sale, that is OFS, of shares through the stock exchange mechanism. Now SEBI in 2012 had issued comprehensive guidelines with regard to offer for sale of shares through the stock exchange. Now in order to further streamline this process of offer for sale, certain guidelines have been issued and they have been reviewed to encourage greater participation by employees. So the revision is more pertinent with regard to encouraging greater participation by the employees. Now promoters of the eligible companies, they can sell their shares through this offer for sale mechanism, and they have now been permitted that they can sell their shares within a period of 2 weeks to the employees of such companies. So they can sell these shares to the employees, and so now the employees, they are having another opportunity to acquire the shares of the company, and they are not much relevant to us in technical detail. So more or less you have to remember that OFS mechanism, it has been revised and some greater participation has been given to employees. And overall you have to remember this, what is this offer for sale mechanism? And we've already discussed this many a times, that this involves selling of shares by the promoters, so the promoters' stake is reduced. Next is participation of NRIs, that is non-resident Indians, in the exchange traded currency derivatives segment or ETCD segment. So NRIs, they would have this exposure to foreign currency and they must be given an opportunity to hedge their currency risks. And that's why they have been permitted to participate in the exchange traded currency derivatives market. So they have to come to this organized space and they have been permitted to participate and hedge the currency risk which is arising out of their investments in India. In this regard, guidelines with respect to trading by NRIs in exchange traded currency derivatives market, they have been issued by SEBI. Next is a review of block deal window mechanism. Now block deal, it is a deal which involves large size of transactions. So SEBI in 2005 had prescribed the guidelines for execution of large size trades through a single transaction. So if you have to sell the securities in crores through a single transaction, this means a block deal. So this has to be well regulated because this is a huge amount of money which is being involved here. And to regulate this, separate set of guidelines have been issued by SEBI in 2005. And now in order to further facilitate the execution of large size deals, this framework has been revised, and now two block deal windows have been provided. One is the morning block deal window and second is the afternoon block deal window. Now the minimum order size for execution of trades in the block deal window has also been increased to rupees 10 crores. So more or less we have to remember that this block deal window mechanism has been revised. Now the next one is with regard to review of securities lending and borrowing segment. So this segment has been again discussed by us many times, and this involves lending and borrowing of securities for different purposes. For example, the different investors, the different institutional investors who are having the securities with them and they're not presently using them, they can lend those securities to someone who has a derivatives position in securities and has to make a transaction with regard to those securities. Now the framework for this particular segment, it has been issued by SEBI in 2007. Now this framework has been modified recently during the year to encourage more participation in this SLB segment. Next is strengthening of cyber security. Now SEBI has recognized that the threats posed by the technological developments, they can hamper the Indian capital markets, and the rise of such kind of threats across the financial domain, they are a challenge for us which needs to be tackled. So in this regard, SEBI has laid down a detailed framework with regard to cyber security and cyber resilience that the market infrastructure institutions have to comply with. They include the stock exchanges, the clearing corporation and the depositories. So they must have a resilient cyber security system so that their systems remain intact in case of any cyber threat. Additionally, a high-powered steering committee on cyber security was constituted, and this one is chaired by a whole-time member of SEBI, and a separate cyber security cell has been constituted which is actively addressing the cyber security issues. So more particularly, SEBI is focusing on strengthening of cyber security. Now next is Secondary Markets Advisory Committee. So like there was a committee for primary market, there is a committee for secondary market, and this was also reconstituted recently, and this one is chaired by Professor Jayant R. Verma, who is a professor of IIM Ahmedabad. So this has been constituted to review the developments in the secondary market and to recommend the measures which can be taken for further development of secondary market space. Now during the financial year, this committee was consulted to discuss a wide range of issues impacting the secondary market. Next is commodity derivatives market. Now first is options in commodity derivatives market. Now after an approval was granted by SEBI, necessary amendments have been made to securities contract regulations, stock exchange and clearing corporations regulations 2012. Now why these amendments they have been made? Because to permit commodity derivatives options in the market. So these guidelines, they were issued with regard to designing of products, risk management framework with regard to options in commodity derivatives market during June 2017. So I believe you are all aware about this concept of commodity derivatives and the concept of options. You will remember the kind of put and call options we have discussed many a times, and the concept of commodity derivatives, that how if you are exposed to certain commodity, like a farmer is exposed to fluctuations in the prices of wheat, baker is exposed to fluctuation in the prices of wheat, so they can hedge their exposure through this commodity derivatives market, and one of the way of hedging is options trading. So for this regard, the necessary guidelines they have been issued during the year. And MCX, so this is an exchange, so MCX exchange, it became the first Indian exchange to launch options on commodity futures, and this was started by commencing trading in options on gold futures in October 2017. Subsequently, NCDX, so this is another commodity exchange in the country, this launched options on guar seed futures in January 2018. So MCX is the first one, and on the second there is NCDX. Next is integration of commodities and securities derivative market by integrating the participants, brokers and operational frameworks for this purpose. So we have discussed in one of the current affairs video that the SEBI is moving towards integration of commodity and securities market. So in this regard, certain actions have been taken by SEBI during the year and they have been discussed in this annual report. So it talks about how the amendments have been made in the relevant provisions of Securities Contract Regulation Rules 1957 and SEBI Stock Brokers and Sub-Brokers Regulations 1992 so that the integration can be given effect to. Further, SEBI operationalized the integration at broker level during September 2017. SEBI in December 2017 approved the integration of commodity derivative market with other segment of the securities at the exchange level from October 2018 onwards. So from October 2018 onwards, the two segments, that is commodity derivatives market and other segments of the securities at the exchange level, they have to be integrated. So in a nutshell, we have to remember that SEBI is wanting to integrate the two segments and not divide the two segments. So this has to be the theme which has to be adopted by us in answering the questions asked with regard to SEBI. Next is guidelines for liquidity enhancement scheme in commodity derivatives contract. Now first and foremost, we must be aware about this scheme. So this is the liquidity enhancement scheme. Now under this scheme, brokers and other market intermediaries, they are given incentives for a specified period of time that they bring in more liquidity and they generate investor interest in the securities which have limited trading activity. So now the focus was to promote the activity in the commodity derivatives space. So for this purpose, this liquidity enhancement scheme, it was introduced by SEBI, and based on the feedback received from the commodity derivative exchange, SEBI during March 2018 permitted liquidity enhancement scheme in commodity derivatives contract. Now an important aspect with regard to this is that any commodity that is classified as a sensitive commodity, so we do not have to promote the derivatives with regard to that commodity which is sensitive. In that particular commodity, there should not be this scheme. So this scheme, which is liquidity enhancement scheme, they should not apply towards the sensitive commodities. Next is criteria for settlement mode of commodity derivatives contracts. So commodity derivative contracts, they must be anchored to their respective underlying physical markets so that they can effectively discharge their hedging function. So we have understood that how the commodity derivatives, they help in hedging of the risks. So SEBI has said that they must be linked to the underlying physical market. So if you are entering into a contract to sell the wheat in future, then you must have that wheat physically with you. So SEBI during October 2017 issued broad guidelines in this regard, and SEBI has decided appropriate settlement mode of commodity derivative contracts. And as per the SEBI regulations, it has been indicated that the first preference shall be given for settlement by physical delivery and not by cash difference settlement. So this has to be remembered. SEBI is giving the first preference to settlement by physical delivery and not the difference in the prices. So this can be an issue that, say, if I have to sell wheat, I may not actually sell wheat. I may settle the price difference between the price at which I have committed to sell that wheat and the price prevailing on the date of exercise of that contract. So this has to be a second preference. The first is to deliver the actual wheat. Next is Commodity Derivatives Advisory Committee. So like there is a committee for primary and secondary markets, there is a committee for commodity derivatives market also. And this one is concerned with regard to effective regulation and development of commodity derivatives market. And this committee has been constituted by reconstituted by SEBI, and this one is under the chairmanship of Professor Ramesh Chand, who is a member of Niti Aayog. So now let's discuss some of the MCQs based on the first part of SEBI Annual Report. Which of the following actions can be taken in non-compliance with the minimum public shareholding requirements by listed entities as per recently issued standard operating procedure by SEBI? Options are imposition of fines, freezing of shares of promoters in such company, debarring directors promoters to take new position of directorship, all of the above. So this we have seen that all these actions, they can be taken in case of non-compliance with MPS requirements by listed entities. So answer to this one is going to be option number D. Next is systematically important NBFCs registered with RBI having a net worth of more than dash have been included in the category of qualified institutional buyers. Options are 50 crores, 100 crores, 200 crores and 500 crores. So this we have seen that in order to expand this ambit of qualified institutional buyers, this NBFCs which are registered with SEBI with a net worth of 500 crores and which are systematically important NBFCs, they are recognized as qualified institutional buyers. So answer to this one is going to be option number D. Next question. The framework for securities lending and borrowing was specified in. Options are 2002, 2007, 2012 and 2017. So this is a very simple straightforward question that this framework it was specified in 2007. So friends, these are the answers. So friends, this was all about our discussion on the first part of SEBI Annual Report 2017-18. Thank you.